There was just one trouble with all of this, and that is that because the producers were exporting and the consumers were importing, so financial imbalances were building up more and more in different parts of the world. The Chinese economy was building up more and more foreign exchange reserves. They're now at about $3 trillion. The Japanese economy had also built up very considerable reserves, and other emerging markets. India, which was almost bankrupt in the year 1989, had something like $250 billion of reserves just 20 years later. This is an extraordinary shift of financial resources. And of course, at the other end of the scale, the United States, which was running trade deficits all through that period, as were certain other countries like Britain, Spain, Australia, all running deficits which were being financed by investments from the producer countries. So the financial flow was going in the opposite direction. Emerging markets investing more and more in the government bond markets, particularly of America, but also of some European countries. And the problem was that as these amounts built up and up, there was sooner or later going to come a point where the markets would say, this isn't sustainable, there's a risk that the debtors can't repay, and there's going to be a crisis. And that's what happened, starting in the year 2007. The crisis broke, and it's always the case with financial markets that the crisis will occur in one particular area, which might seem to be almost random. In this particular case, this was the American subprime housing market which started the crisis. But it very rapidly spread through the financial markets of the world. And in one sense, we're still living with the aftershocks of all of that. Because although that crisis, which became very serious in the winter of 2008-2009 and very nearly pushed the world into depression, although we stepped back from the brink and coordinated government action by the major economies of the world prevented a real disaster, prevented real depression in the style of the 1930s, in a sense, what it did was to pull us back from the brink but not solve all of the real problems of imbalances. And indeed it is still the case that the world's economy suffers from real economic imbalances. It is still the case that the United States consumes too much, saves too little, invests too little. Britain is another country which has been consuming too much, investing too little, saving too little. And there are other examples in the Eurozone. And on the other side of the coin, you have countries like China, which have been exporting too much, investing too much, saving too much, spending too little, and therefore building up these surplus reserves. This imbalance still exists, and whilst it exists, it means that global growth will always be at risk of some other financial crisis breaking out. And in a sense, that's what we're seeing at the moment. The difficulties in the Eurozone are the result of those sorts of imbalances. You have countries within the Eurozone that have been spending too much, saving too little, investing too little. Greece is an example of that. You have countries that have had very low growth, but have been running substantial debt. I mean, Italy, of course, is the well-known example of this, where although its primary fiscal position is actually reasonably sound, they're roughly speaking in balance, the full fiscal position is in deficit, and it's being funded by the issuance of debt, and the debt is getting more and more expensive, and that was the basis for the crisis in the financial markets in recent weeks, which has led to the events in Italy that we're all familiar with, a changing government and a new start with a commitment to reform. What is clear is that these financial imbalances have to be resolved by paying attention to the real economic pattern of development. And in country after country, there is a need to rebalance the economy, as well as a need to do this on a global level. In the case of Italy and Greece, you have new governments now committed to reform of the public fiscal position, addressing bloated public sectors, addressing issues like retirement age, addressing the need to make the countries more competitive on the international stage, in the international markets. You have, in the case of China, a government who clearly understand that they need to rebalance their economy and develop domestic demand in a way that allows more imports into China and a greater ability to meet the rising aspirations of their own people through better services such as in healthcare and in education. So the Chinese government is currently embarked on a big program of developing its own domestic market and its own domestic services in such areas as healthcare, which will have the effect over time of rebalancing the economy away from excessive dependence on exports and on investment. In the United States, there's a need to rebalance the economy, and the President has been vocal on the need for the United States to be more successful in exporting in order to address its trade deficit. Many people worry, of course, about whether enough attention is being paid to the fiscal position of the United States, and time will tell whether or not the economy is rebalanced in a way that enables it to continue to grow sustainably. But I look mainly at Europe, and I want to spend a little bit of time on Europe. And I'm going to begin particularly with my own country, Britain, where it is very clear in the wake of the financial crisis that we have to find a new growth model. Britain, in the run-up to the crisis, was, as I've already implied, spending too much, borrowing too much, saving too little, and investing too little. And what we now have to do is to rebalance the economy in a way which allows it to pay its way in the 21st century. Britain's had a trade deficit, actually for a long period of time, something like 40 or 50 years. Britain's had a weak trade position, and trade has been a drag on growth. What we now know coming out of the financial crisis is that we can't go on growing the way we were before the crisis. We have to grow on the basis of a stronger trade performance and on better investment performance, because consumption is going to be weak for a considerable period of time, and we need to reorient the economy towards the international markets. That is our principal challenge. That is why I'm excited by the job that I've been asked to do by our Prime Minister David Cameron, because trade is crucial to British growth going forwards. In particular, we need to ensure that more and more smaller British companies get involved in the international markets. The evidence is compelling that companies that get involved internationally become more efficient, indeed are more efficient to start with, and become more efficient as they do so. They become more dynamic, they become more flexible, they become more profitable, they grow more, and they create more jobs. All of this is what we need to achieve in Britain in the years ahead, as we rebalance away from an economy where growth has come too much from consumption at the expense of the balance of payments. So our current strategy is very clear. It's focused on a number of key strategic imperatives. To begin with, we have to make sure that we balance our fiscal position. Britain has been running a fiscal deficit that's actually quite high, indeed about as high as Greece's fiscal deficit. Higher Poland's slightly. And we have to address that. And the British government is indeed committed over the next 4 years to reducing the fiscal deficit to zero by the year 2015. We've also been reforming the way in which macroeconomic demand management is carried out through the central authorities. The role of the Bank of England is being evolved to give it clearer authority over the flow of credit through the economy, through the business